So the next one is discounted cash flow model, and under that we mostly use the FCFE model, free cash flow to equity holders, FCFE model. So this is a variation of the FCFE model. So as we have talked about, as we have previously talked about net capital expenditures, financial service firms mostly invest in intangible assets such as brand name and human capital, which is normally routed through profit and loss and not capitalized in books. Consequently, there's hardly any capex appearing in the balance sheet of banks and NBFCs. And also, in case of working capital, if we define it as the difference between current assets and current liabilities, a large proportion of banks' balance sheet would fall into one or the other categories. So most of the banks and NBFCs, they mostly take loans for a short period, and they mostly advance loans for a longer period of time. So if a bank or NBFC is raising funds to commercial papers, which have a maturity period of less than 1 year, and they're giving loan for to a customer, suppose for 5 years, then and if we define current assets as something which is expected to be realized within 1 year, then there would be no current asset, but there would be current liability in the bank's balance sheet. In that case as well, there would be an inflow of working capital, but there would be no outflow of working capital if we define working capital as a difference between current assets and current liabilities. Due to these, all the reasons that we have talked about till now, the method that we use to compute the value of a bank under income approach or the discounted cash flow approach is FCFE, financial service firm, equal to net income or profit after tax minus reinvestment in regulatory capital. The bank is required to maintain a CRAR ratio as defined by RBI guidelines, even though they're not required to invest in capex and working capital, but they're required to maintain a CRAR ratio. That's why we include reinvestment in regulatory capital as a reinvestment uh, thing in FCFE model. So this is quite different from a non-financial service firm where FCFE is equal to net income minus capex minus working capital investment. And then you also have non-cash expenses, but in case of banks, there are hardly any non-cash expenses. And it is quite difficult to differentiate between non-cash expenses as well in case of bank. There's no depreciation, no amortization of intangibles, since mostly they are rooted through profit and loss. So that's why we use this modified FCFE formula for banks and NBFCs, which is net income minus reinvestment in regulatory capital. The third one is excess return model. In this, we compute value as equity invested currently, which is the book value as on the valuation date, or the opening book value of equity, plus the present value of expected excess returns. Now, excess returns are nothing but difference between ROE and the cost of capital, cost of equity. ROE is the full form of ROE is return on equity. So if a bank is having a cost of equity of 12%, and if the bank is able to generate ROE of 15%, then the 3% gap would be excess returns for a bank. That would increase the value for a bank, for the bank's shareholders. So excess returns are defined as difference between ROE and the cost of equity. So in case a bank is earning more than the cost of equity, it will have a positive impact. And if in case the bank is generating negative ROE, or ROE lower than the cost of equity, then it will have a negative impact on the value of a bank. Then in case of positive ROE or positive impact, the value would be more than the equity capital invested currently. We'll talk about all this when we move to the Excel file. So the two key inputs needed to value equity in the excess returns model are equity capital currently invested, or the book value of equity as of the valuation date, and the expected excess returns, which is nothing but the difference between ROE and the cost of equity. Any queries? Let's now move to the market approach. So we'll be talking about two ratios in the market approach: price earning ratio and price to book ratio. P ratio is price per share by earning per share. So if we have a set of comparables with us, a peer set of comparable listed comparables with us, we need to have their price per share or the market price as of the valuation date, and then the earning per share to compute the P ratio. Now, P ratio also can be backward looking or forward looking. So if we are using earning per share for the last 12 months prior to the valuation date, then it is normally called as P ratio TTM, trailing 12 months. So it is normally known as a trailing P ratio. And in case we use earning per share, which is the denominator, if you see forward-looking earning per share as the denominator, suppose we are valuing bank as on 31st March 24, and we are using EPS, expected EPS for FY26. Then it is normally called as forward-looking P ratio. Both the ratios are quite prevalent while valuing banks and NBFCs. So there are three inputs that go into computing a P ratio, or there are three major variables that impact the P ratio: expected growth rate, payout ratio, and the cost of equity. So this is a formula for a justified P ratio. This is computed using the Gordon growth model. So the justified price to earning ratio, the trailing P ratio is payout ratio, which is nothing but dividend upon EPS, dividend paid upon EPS into 1 plus growth rate divided by cost of equity minus G. So this is known as justified P ratio, justified P trailing ratio. So using this, we can compute what is the justified P ratio for our company. So suppose we know the figures for expected growth rate, the expected payout ratio, and the cost of equity. Then we can compute the justified P ratio for our company, and then we can even compare it with the listed comparables. If the justified P ratio for our company is coming out to be lower than the listed comparables, then it can mean that our company is undervalued, and vice versa. So P ratio should be higher for financial service firms with higher expected growth rate, higher payout ratios, and lower cost of equity. The next one is price to book value ratio. Price to book ratio is equal to price per share upon book value of equity per share. Similarly, even in this case, if we have a set of comparables, listed comparables, we have the price per share and their book value per share, we can easily compute the PB ratio. So PB ratio is a function of four variables. Sorry, there's some mistake here. So it is a function of four variables: expected growth rate in earnings, payout ratio, cost of equity, and return on equity. So this is known as the justified price to book ratio. So if we have these four variables with us, return on equity, growth, and the cost of equity, and the return on equity, we can compute the justified PB ratio, and then we can compare the justified PB ratio with the ratio with the ratio that is coming out with through the set of comparable listed companies. If the justified PB ratio is coming out to be lower than the listed comparables, it can mean that the company is undervalued, and vice versa. So higher growth rate in earnings, higher payout ratios, lower cost of equity, and higher returns on equity should all result in higher price to book ratios.